Hello and welcome to Chartbusters. I'm Nigel. With me is Manglam. Well, the markets are under pressure, but we have got a new kid on the block, that of Afcon's Infra. They've listed at 7 to 8% discount in comparison to its issue price. We have with us Mr. Srinivasan, who's the MD of the company, to discuss more with regard to how things are shaping up. Hi, Mr. Srinivasan. Good morning and good to see you, Ben. Well, the stock listed at a discount of around 7% odd, but that dip has got bought into. So the street clearly would like to understand what's the way ahead for the company. Now, the last reported order book that we have is around 32,000 crores. And you had briefly mentioned that your L1 enclosed around 8,000 crores worth of order. Could you tell us what is the updated order book and where do you see you ending this fiscal year with in terms of an order book position? Please go ahead.
Good morning. We have started the year with about 31,000 crores of order book. And during the year, including L1, we have booked about 20,500, out of which 11,500 we have got the orders in hand. Another about 9,000 we are L1 at different stages. After our meeting last time, probably we have another 1,000 crore L1. So with that, 9,000 crore is L1. If typically we don't include L1 jobs in the order book, but if we take L1 also into account, our order book as on date is about 45,000 crores. And we are looking at normally between 2.5 to 3.5x of our book-to-bill ratio. So therefore, we are very comfortably positioned as things stand today.
All right. So you're closer to 40,000, 45,000 crore in terms of an order book. The remainder of this year, two-part question. One, the remainder of this year, what are the kind of order inflows that you're expecting? Because a lot on the street, expect domestic ordering pace to come off a little bit. So if you could give us a sense of what kind of inflow are you expecting in the second half of this year? And what is the execution that we're looking at in this year? What kind of revenues can you do?
That is something we have already bid for quite a few projects, which bids of which are to be opened yet. We do expect to book a significant amount of orders, at least not less than another 5,000 crores or so. And in terms of revenue growth, we have been growing at over a 20-year time frame, 18.5% CAGR. While 25 could be flat, on a longer term horizon, we expect to maintain about 15+% CAGR. Last 5 years, our CAGR is about 16%. And therefore, we expect around 15+% CAGR over the next 3 to 5 years.
So this year will be no growth, right?
This will be a flat year, like marginal growth could be there. About
why is that, sir? Why, if you could explain why exactly is that? Because you're
last
gaining
couple of
orders,
years, we have on a calibrated manner booked much less orders. And that has resulted in a less number of orders available for execution during the year, which is resulting in a flat turnover for the year.
Okay. All right. Flat turnover this year, but post that, you're expecting to continue to grow at around 15% CAGR on revenues. What about your margin profile? Could you tell us how do you see margin shaping up? The last time you joined in, you had mentioned that exports, they enjoy higher margins in comparison to what the domestic business does. And I asked you this because your margin profile is even higher than an L&T. So what's the internal hurdle rate at which you accept the order or you reject it? Please go ahead.
In terms of EBITDA level, we are at a fully diversified setup, we are probably one of the highest. 11.6% EBITDA is what we achieved last year. And we would sustain the EBITDA at 11 plus on an ongoing basis. There could be further improvements, but at this point as a guidance, I would put it 11+% EBITDA would be a sustainable basis for Afcons. And in terms of, I would not like to compare with the competitors. Suffice to say that on a fully diversified setup, our EBITDA is at the highest level. In terms of overseas business, I would say our margins are about 200 to 300 basis points higher than the domestic markets.
Right. So what exactly are you expecting in terms of an overseas/domestic mix going forward? What will be this ideal mix? Because currently, while domestic ordering, a lot of people are expecting it to pause a little bit. Exports also, we aren't seeing great growth in export markets. So if there is any particular geography that you're focusing on, what's the ideal mix here?
We are looking at, yes, we have been maintaining a 70-30 ratio between domestic and exports for the last few years. While we would like to sustain that ratio in the periods to come, temporarily our export order book has come down a bit. In the current pending order book, if you look at it, 76% is domestic, 24% is exports. And going forward, we would like to sustain 30-70 between exports and domestic. And while order booking slowdown everyone is talking about, our size is such where for our requirement, procurement of orders should not be a problem. For example, when everyone is talking about a slowdown in the current year we have already booked the highest ever order book of, including L1, if we take it, 20,500 crores, which is the highest ever booked by Afghans. Right. Therefore, it's a question of focusing on the right jobs and going for the right jobs where comparatively competition is less, a complex job that will take us to wherever we are. In terms of geographies, we continue to be bullish on Africa and reasonable in neighboring countries, and Middle East, Saudi Arabia market we are bullish, and we are entering into newer geographies in erstwhile East European countries, in some of those countries where there is a good funding available from various sources. There we believe opportunities are higher.
Okay, all right. Talking about funding, your debt will come down to around 1,200 crores from 1,800 crores, as you told us, and it will result in savings of around 55 to 60 crores. That's because of the IPO. But since you have such a big order book and your working capital requirement could move up as well, where do you see the net debt number headed? And also, what could your effective cost of borrowing be?
The cost of borrowing for us has been one of the lowest in the overall setup. Our cost of borrowing currently is around 9.4%. We don't expect a significant downturn unless there are rate level changes or other thing. In terms of rate of interest rate, our interest in absolute terms will come down because 600 crores today we are paying to the bankers towards loan repayments, and some part of general corporate purpose also could go towards that. But we would use this, I would say, to leverage. And in terms of working capital, we don't expect a significant increase. For the simple reason, even in terms of order book, as we have explained earlier also, we follow a risk management process where cash flow negative projects are eliminated. Therefore, we do expect a larger non-fund based facility requirement than fund-based requirement. As we had explained to you earlier, our working capital number of days is 63 days net working capital, and we hope to sustain between 60 to 70. There is not going to be a significant variation in terms of working capital. And you would notice that we are one of the best in the industry in terms of working capital management.
No, so 600 crore interest that you pay, just quickly before we let you go, I'm looking at the objects of your issue. 500 crore goes towards prepayment of borrowings and 350 crores towards funding long-term working capital requirements. So that's nearly 850 crores of, otherwise borrowed money being off your book. So should we see around 85 to 90 crore of interest cost reduction on an annual basis? Is that the right calculation?
It's various factors, because interest is something which goes up during the year and comes down towards the end. And the government in the first 2 quarters are, in terms of payment time cycle, a little elongated. Taking all that into consideration, I think we should look at interest coming down. But in terms of absolute number, I am not in a position to say how much.
All right, take that point. Wish you good luck for the remainder of this year, and congratulations once again on listing on the bourses. Now your responsibilities towards shareholders increases a lot more. We promise to keep having these quarterly conversations with you to keep your shareholders and our viewers abreast of what's taking place in the country. Thank you so much, sir, for joining in.
Thank you. Thank you very much. It has been an exciting journey, and thanks for your support as always. Thank you.
All right. With that, we'll shift focus to our special segment. We get you ideas of profit from our colleagues at Money Control Pro. Today, we have Anant Chaudhary joining in.
Stock idea is Crompton Greaves Consumer Electricals, a 75-year-old brand in electrical consumer durables and lighting space. It is a leading player in fans with market share of 28 to 29%, also having a healthy market share in pumps, LED lightings, and geysers. The company is well positioned to benefit from shift towards premium and energy efficient products. Crompton's market share in the fan segment has increased from 17 to 18% to 25% in the last couple of years. It aims to reach 40% in next 3 to 4 years by increasing the share of premium ceiling fans. Company is a market leader in residential pumps. Now its market share in agri pumps has also increased to 8%, which now contributes 20 to 25% of the pumps business. The headwinds for lighting industry are likely over. Company has discontinued its CFL business and will focus on LED business only. Hence, it should witness higher revenue growth going forward. To diversify into kitchen appliances, company acquired Butterfly Gandhimati Appliances in 2022, which has a strong brand recall in South India. It has experienced subdued performance so far. However, the restructuring of this business, which involved reducing its reliance on e-commerce and lowering its institutional sales, which is nearly completion. Stock is down some 15% from the peak and trades at 36 times on FY26 earnings.
All right, with that, we'll slip into a short break. Don't go anywhere, though. On the other hand, we have on the other side of this short break, Umesh Chaudhary, who's the MD and CEO of Taga Rail Systems, joins in to discuss the company's quarter gone by.
Welcome back. Well, the breadth of the market as well is worsening a little bit. Now we're down to around 350 stocks that are advancing, and that number was close to around 550 earlier. So those lines actually are getting further apart. A few stocks that are deserving special mention. You had Siemens that was in the green actually to kickstart trade. That's moved into the red. So let's get that stock up for you on the screen. PNB is another name that was in the green. That as well has moved into the red. On the flip side, KPIT Technologies, a stock, pulled back a goodish bit post its numbers. But it seems to be finding some kind of support at around the 1350 odd mark. Even today, intraday, we have seen a bit of a bounce back out there. And Godfrey Phillips as well. That's the other stock in there that's moved into the green. What else, Mangla?
Nigel, I'm looking at Gillette. No two ways about it. Great numbers coming in last week itself. Ever since that, the stock is held up fairly in the green. Currently closer to its 52-week high. Today as well, sitting with a gain of 4% at a time when the mid-cap index is down about 1.5%. So what we'll do is we'll keep an eye out on this one. Over the last 7 days itself, 25% in terms of gains. That's a clean shave that we see on Gillette. Take a short break, come back on the other side. We'll get you markets and more stock-specific action, perhaps get in a conversation with the management of Taga Wagons as well. Welcome back. You're watching us here on Chartbusters. Let's get chatting with the management of Taga Rail Systems. The company reported a steady set of numbers in the second quarter. Revenues grew by about 13%. Similar was the growth that we saw in the EBITDA and the net profit as well. Umesh Chaudhary, who's the MD and CEO of Taga Rail Systems, joins in to discuss the quarter gone by. Thanks a lot, Mr. Chaudhary, for joining in. Always a pleasure speaking with you. Season's greetings to you and your family as well. Most importantly, the run rate in this quarter in terms of execution picked up. You did about 2,600 wagons. You've been talking about clocking 3,000 wagons a quarter or 1,000 wagons per month consistently. So the question is, in the second half, do you do that? And on an average for this year, what's the kind of execution run rate that you're looking at? And your order book update as well. If you could give us, your overall order book update, how much is that? How much of that is freight? How much of that is passenger and JVs?
Sure. So good morning. Always a pleasure being with you, and season's greetings to you and the team of CNBC. The quarter gone by was a satisfactory quarter because we've been able to actually breach all our past records in terms of revenue, in terms of EBITDA, in terms of the profit before tax. It's been the highest ever quarter for the company. And in terms of the execution, we did an execution of 2,700 wagons, approximately 2,690 wagons. That gives us a run rate of close to 900 wagons per month. So we are not really very far off from our target of getting to 1,000 wagons per month on an average basis. we should be able to achieve that within this financial year. We are trying to get closer to that within this quarter, but definitely before we would be able to achieve and surpass slightly the target of 1,000 wagons per month on an average. The order book, the overall order book of the company was about 25,000 odd crores. If we divide it between our share of the JV and our own direct orders, it's more or less half and half. And again, if we go into the split between the passenger rail segment and the freight rail segment, it is again approximately half and half, maybe 55-45 thereabouts. So it's a very well spread out, well hedged order book that we have, order portfolio that we have. And what we are now doing, the focus is now to improve the execution or to pick up the execution of the passenger side, which we are also fairly confident that we have started the Bangalore metro production. We are likely to start the Ahmedabad metro production in Q4 or beginning of Q1. The first train of next year, the first train should go out. So with all of that, both the segments, the freight and the passenger, will start contributing, which has till this quarter, it has been primarily the freight. The passenger has a very, very small role to play in the growth of the numbers that we have achieved.
Okay, all right. Hi, Mr. Chaudhary. Congratulations on the set of numbers. Market today is a little weakish, but otherwise you're going according to that guidance of close to 900 to around 1,000 wagons per month. Got that. What does it mean in terms of revenues for this year and more importantly for next year? Because that's when metro segment as well will come into play. So what could the outlook be in terms of growth? And also what does it mean in terms of profitability?
So, the profit margins, as we have always said in the freight segment, we are at about 11-12% EBITDA, and the operating leverage would maybe improve slightly and some backward integration, but it will be in the vicinity of 12%, I would say thereabouts on a longer term perspective. I'm not talking of a quarter, but on a maybe average of 3 or 4 quarters. In the passenger, again, we are expecting 10% to 11% EBITDA until our own propulsion comes in. And when the propulsion starts coming in, then we should see a jump of another 3-4%, so going up to 15% targeted EBITDA. For the revenue growth, we are looking at stabilizing the freight at 1,000 wagon level over the next year as well. The passenger is going to be the real game changer for us. The metro segment will start contributing in the next financial year, and the year after, the metro segment as well as the Vande Bharat, both will start contributing. So really what we are looking forward to in terms of the real growth that we can see in the company, the next, I would say, quantum jump, not the incremental growth, is going to be the following financial year, that is 26-27.
So let's talk about 26-27 and 27-28 itself. If you could give us a sense of, so 12,000 freight wagons are on the cards because that is the number that you hit consistently. 26, you do 12,000 freight wagons. How much comes in from passenger? And the year after that, how much comes in from passenger metro? What kind of margins are we looking at? Because by then, I think the propulsion will come in too.
Yeah, absolutely. So I would not get into the financial numbers because that would be giving the future guidance, but which we do not do. But what I would give you is the capacity that we are creating. So the capacity that we are creating is to produce approximately 350 to 400 metro coaches and 350 to 400 Vande Bharat coaches. And both of this will be in full. And in order to give you a sense of magnitude, order of magnitude, the metro coach is 10 crores a coach, and Vande Bharat is about 7-8 crores. Our share is lesser because it's in a consortium with BHEL, but that's the overall order of magnitude. So the potential that the passenger segment, and I would rather go up to FY30, the passenger segment has the potential of being a much larger business than the freight segment. And, this ramp up will continuously, I would say every quarter from Q4 of the current financial, we will see a growth ramp up in all the parameters of the passenger business.
So at full level, 3,500 crore comes in from passenger because that's 10 crore per coach. You have 350 coaches per year. And Vande Bharat, assuming you have 50% share out there, gives you around 1,800 crores in terms of sustainable revenue. That's a fair understanding?
Yes, absolutely. For the time being, yes.
Right.
Of course, we look at further Vande Bharats coming in, and that would definitely help grow further.
Take that point. Thanks a lot, Mr. Chaudhary. Always a pleasure speaking with you. We'll obviously keep getting any comment from you around order wins and order activity for the railways as well, and to understand your business a lot better as well. Speak to you during the quarter two. Thank you so much for joining in. With that, we've run out of time on this edition of Chartbusters. From Nigel, me, the entire team, thank you so much for watching. The team of Trading Hour takes the market action ahead, currently at the low point of trade for the Nifty Bank and the Mid Cap Index.